Because Namibian Breweries reporting an 18.9% increase in their full-year headline earnings per share, at 177.8 cents. Now looking at overall beer volumes in Namibia continuing to grow at double digits, that's delivering 12% growth compared to the previous year. Now the company is confident that amidst the increasingly competitive environment here in South Africa, their joint venture DHN Drinks will remain important for growth in their beer portfolio. So let's unpack how the company performed. We've got Romain Mostad, Head of Research at IJG Securities, joining us on the line. Romain, thanks for joining us today. So I think it's important to take a look at the losses that this specific JV continues to incur. I mean, what were your thoughts on the numbers that came through this time around, the fact that the losses here continued in the South African JV? And what are your thoughts in terms of the turnaround that the company is projecting there?
Yes, the losses are definitely a bit worrisome to us. We projected the losses to be in the range of 100 million and overshoot, clearly coming in at around 109 million for the JV. And the fact that they wrote off the deferred tax asset for those equity losses is also maybe an indication of the likelihood that JV will turn profitable in the near future. So definitely a cause of concern. And when you look at the stock from a valuation perspective, that the fact that there must happen something on the DHN level regarding a Namibia Brewery and maybe some kind of transaction taking place, that's the main sort of uncertainty in the Namibia business, keeping us from recommending a buy on the stock.
Mm-hmm. I mean, another factor that they point out, and even though they've got strong growth coming through from the local market, it's an increasingly competitive environment for them. So what do you make of the performance in the local Namibian market right now, and how they're positioned from a brand perspective, from a cost perspective, in light of this dynamic?
Yes, the fact is they continue to build market share in Namibia. They've mentioned facts that their market share is sitting around 85% currently, which is very, very strong. But on the other hand, it also sort of, you can see that the market is saturated to a certain extent. I mean, where the marginal increase that you can see into the future is all that or decreasing by as we speak. And then the other problem is that SAB is setting up brewery in Okanya, which will be competitive within, say, 18 months' time. Mm-hmm. So growth, revenue-wise, is definitely a problem looking 2 years down the line. But the one advantage that we've seen the whole time is as they grow revenues in Namibia or just volumes, it's very positive for the trading profit margins as they realize a much higher price in Namibia compared to the export markets and South Africa. Mm-hmm. So there's immediately that pickup in terms of operating margins, which then stimulates growth further up until now.
Yeah, but as you say, SAB Miller certainly is showing that it's concentrating on the opportunities there. Another issue right now is the fact that they've focused on so many export markets, and they're looking to tighten that focus right now and look at the core export market. So what has been the issue around that, and what are your thoughts in terms of the export markets that they should be looking to right now?
So basically the export markets was a challenging environment. I think in general, as you've mentioned a couple of times, it's a very fierce competitive environment that they find themselves in. And I think the focused approach is definitely the right way to go, and maybe to identify specific areas within each market, how to gain market share. But it's not an easy game out there, and they continue to reflect it as tough. One thing that we should note is that export markets are still very small in the Namibia stable. I think it represents about 200,000 hectoliters in the total context of, say, 2.7 million. So only 1/10 of total, representing only 1/10 of revenue.